Good morning, folks. I hope you've had a great week. So, as we head into the Easter weekend, let's examine egg prices. Okay, so apparently, the US consumers have had a tough time with eggs, and since the time Trump took over, egg prices have gone up from $4.9 a dozen to almost $6.3 a dozen. And this is mostly because of a bird flu, due to which they had to cull most of the chicken, and they have a supply shortage. They've been trying to import from other parts of the world, mostly Europe. Europe itself has been struggling with inflation in egg prices. Parts of Eastern Europe have actually seen a 46% jump in egg prices. That's serious stuff. And even if you were to look at American egg prices, which is about $6.3 a dozen, compare that to what we get eggs for. The US consumer pays about 44 rupees an egg, which is 10 times what we in India pay for an egg. Now that is something to ponder over as we head into the Easter weekend. And with so many memes doing the round that eggs are so expensive, people in the US are painting potatoes and putting it to their baskets instead of buying eggs. So there you have some. So let's look at more domestic news. So I believe that mall developers are betting more on smaller cities than larger cities. There are enough and more malls, I guess, and consumption not going up at the same rate as what developers expected to rise in tier 2, tier 3, tier 4 cities. So that is where a lot of development is going to be taking place by the biggies, not the small developers. So that's going to be interesting to see. And you might have been listening or hearing a lot about what is known as the Plaza Accord of 1985. I thought I would dwell a bit on that, being inspired by the editorial on Monday by Ajay Shah and Ila Patnaik on their asking, is there a new Plaza Accord on the block? And dollar depreciation is underway without requiring an accord. So what is the Plaza Accord? Or rather, what was the Plaza Accord? So in 1985, the US decided or figured that it was running large, that the dollar was rather overvalued as compared to other currencies, and they wanted to depreciate the currency. They could not do it without the agreement and cooperation of other large trading partners. So the large trading partners at that time were Germany and Japan, and they figured that they should be working with them. So I guess the world was a better place as far as cooperation was concerned. I don't think the US can get cooperation from other countries as easily as it did get in those times. You must remember that both Germany and Japan were both continue to remain obligated to America for having got them out of the morass that the Second World War had left them in, to becoming an economic superpower. So it was an agreement where Japan and Germany agreed to let their currencies appreciate against the dollar. So relatively the dollar would depreciate and get out of the overvalued situation, making it more competitive. So as a result of this, we actually saw the Japanese yen appreciating by 46%. And that, as you can imagine, would have changed the dynamics of the Japanese economy. The Japanese economy till then was growing at almost 6% per annum on the GDP, and had become an exporting superpower. With the Japanese yen going up 46%, you can imagine what happened to its competitiveness in exports. Germany also faces that problem. And it is, of course, written about that it was the Plaza Accord that changed the Japanese economy to a stagnant economy. We saw the lost decade most likely as a result of the Plaza Accord, where Japanese GDP growth fell to almost 1% initially, and then nothing for many years, and it's just beginning to pick up a little bit now. So is another Plaza Accord required, is what Ajay Shah and Ila Patnaik say. And they make some pretty interesting points here. Okay. So just like in 85, even now, then too the US felt there was a problem with persistent dollar overvaluation. What happened there? The major countries got together, came to an agreement, and then engaged in some signaling and some coordinated intervention in the currency market. This kicked off a 40 to 50% depreciation of the dollar, primarily against the yen and the Deutschmark. The euro was not there at that time. We are, of course, not in the precise situation of 1985, and any attempted Mar-a-Lago Accord will diverge from this in many ways. We should ask, what is the place of the dollar in the post-tariff world, and could a Mar-a-Lago Accord that resembles the Plaza Accord come about? So he makes 6 points. Sustained dollar overvaluation owing to strong capital inflows was based on respect for American institutions. And the US was a safe haven because people all over the world trusted in American institutions. Through the first 83 days of the second Trump regime, the world has become more skeptical about American institutions. It looks a bit like an emerging market. The most important exchange rate where we see this is a dollar-euro exchange rate. Ordinarily, the introduction of a tariff which reduces imports should generate dollar appreciation. Instead, the dollar has gone from 0.97 a euro to 0.88, a depreciation of about 9% against the euro. And if you were to look at it more broadly, it's about 4% against all other indices. The interest rate for US bonds, as the long US bonds, has gone up, and that for German bonds has come down. It should have been the reverse in any other manner. But in this particular crisis, we are seeing a lot of things break trends and go against what history has shown us. And much of this is because of the loss of trust in the US, which is why the dollar is depreciating and people are asking for a higher interest rate to be subscribing to US bonds. So this is going to be a challenge. At that time, you had Japan and Germany who are willing coalition partners. They are not now. And in any case, the big trading partner is China. Okay, and China is in no mood to sit and negotiate and cooperate with the US. So the possibility of an accord is lesser. And you should also understand China fixes its currency to the US dollar. It does not have a free float like Japan has, or the euro. So this is going to make it more difficult too, to allow the yuan to appreciate. And just imagine if China were to appreciate the yuan versus the dollar, what happens to its export competitiveness? So it's going to be very difficult to get that done. Okay, and of course in 1985 the world was a smaller place and the depth to the foreign currency market was much lesser than what it is now. So it was more easy to manipulate, and developed nations were able to manipulate the currency market to whatever outcome they wanted, which is not the case today. Okay, and it says in 1985, the path to negotiation for the Plaza Accord involved the danger that there was protectionist sentiment in the US which needed to be staved off. This created conditions where all parties could be brought together. Today, the US has imposed tariffs, retreated from the Western alliance, and offended China. It will require extreme diplomatic skill to bring about a G7 plus China agreement under these conditions, particularly when 2 of the 8 countries have populist and nationalist leaders. So it's not going to be easy, and it's not that they have the Trump administration has the diplomatic depth to be able to negotiate these. Then the last point, the objective stated here, that is a 20% decline in a broad dollar index, is tantamount to a significant fall in purchasing power of the American consumer. And this is not going to be easy to manage politically, and the resultant inflation, which is not going to be easy to manage. Okay, and we don't know what will happen to employment. Is it going to increase or decrease because of all this? So we are in a far more complex world to have another Plaza Accord. It may not be possible. It would rather be more disorderly, in my opinion. Good news for India is that the inflation numbers have come in and retail inflation is lower. So retail inflation, according to government data released on Tuesday, eased to 3.3% in March over the same month last year, compared with 3.6% in February. This is the lowest reading since August 2019. Okay, some of it may be thanks to last year's high statistical base that made this year's price increases look small. But a key reason was the dip in food inflation, which fell to 2.7% from 3.8%. So this was what was keeping inflation numbers high all of last year, and with that dipping, the numbers look far better. And there is also a forecast of a normal monsoon for India. Okay? And in fact, 5 points better than the normal 87 centimeters that is the Indian average normal. So if we have a better monsoon, we can see inflation numbers being maintained at this level, if not falling further. So of course, the moment you speak of inflation, we have to speak of interest rates. And this gives us confidence that the RBI can cut more in the coming months. Maybe another 0.5% in 2 different tranches. But there's a distinct possibility given that inflation is now under control as far as India is concerned. This is good news. So FMCG companies are again feeling good because with better monsoon, better rural consumption, better turnover and better volumes for staples and discretionary goods across. So let's hope that pans out. Okay, so as this is good monsoon will help further boost rural demand, which has already started to witness an uptick in the last few months, and this in turn will also stimulate urban demand. It is the 4th consecutive year that India is expected to see a good monsoon, and this will help boost the staples business. Okay, so let's all cross our fingers and hope this happens. So this would be in addition to the boost coming in from the lower income tax this year. So you have good monsoon putting more money in people's hands. You have lower taxation putting money in people's hands. So I do think it may help boost consumption. Okay. So we also have reports that crude oil purchases from the US surged to a 27-month high for India. Okay, so this is good news. One, of course, is that crude oil prices are lower, and if we are able to buy more crude oil and LNG from US, it would reduce the trade deficit that we have with US. There's about a $35 billion that India commands a sizable $36 billion trade surplus with America and a deficit for US with India. And at least half of it we can cover by increasing our purchases of crude oil and LNG, which makes it far more easy for India to close the trade gap and possibly more favorable terms and tariffs because of that. Because if you recall, the whole idea of imposing tariffs was to close the trade gap between US and every other country in the world. So India could possibly do this in a better fashion than other countries, which also leads the finance ministry in some of its reports saying that we may not be as much impacted by the tariffs as many other countries, for this reason that we may be able to negotiate better terms with America, and in any case have a large domestic market. Okay, so while some agencies have said that GDP growth could come down to maybe 5.5% instead of 6.25% in the worst case, let's see, we'll still be in the reasonable range of 5.5 to 6.25%, given what is happening. Okay, there's of course surplus in oil supply across the world and a falling oil price at the same time because of lower consumption, lower global growth. So this is going to have different kind of impact. Now, if you're looking at Russia, as the editorial says, Russia is dependent on oil exports to fund its war machine. And if their revenue is going to fall for any reason because of either lower prices or lower demand or sanctions, it may be that much more difficult for Russia to manage its war machine. Okay, whereas whereas in the US it's a different kind of a problem. If prices fall and continue to fall in this manner, it may no longer be economical for them to drill out shale gas and supply. So they have a high price point, high cost point rather, which makes it more difficult. Okay, whereas the Gulf states are willing to pump out more and make up the revenue by selling more volume, even though it may be at a lower price per barrel. So all this is happening. Coming to today, of course, it says the majors, IT majors, whether it is Infi, TCS or Wipro, have all come out with their numbers, and the numbers don't look really good. As a result, you've seen the IT index fall considerably, and the headline on today's Business Standard says IT slice of Nifty 50 pie shrinks to a 17-year low. So the sector's weighting in the index has slipped to 10.2% from a peak of 17.7%. That is a major shift in my view, and we have to be watching this sector carefully. It has a lot of biggies, but all of them are seeing margins fall. And given the pessimism on US orders coming through, we are going to probably see a very muted year from the IT majors in India, who are more service dependent. Okay, in net profit has fallen for all of them in the Q4 numbers in the FY25 after the Q4 numbers have come out, ranging from 1.8% fall in net profit for Infosys to 5.8% for TCS, and a huge 18.9% fall for Wipro's profit after tax. And in all the cases, margins are definitely lower. So we have to be watchful. Okay, and then going further in, okay, of course we have the European Central Bank cutting interest rates by a 0.25% to 2.25%. So this is good for European economy. The European Central Bank lowered interest rates for the 7th time since last June, as global trade tensions threatened to derail the region's economic recovery. The deposit rate was decreased by a 0.25 point to 2.25%, as predicted by almost all analysts polled by Bloomberg. So officials also dropped the word restrictive from their statement in relation to monetary policy stance, but stressed the headwinds Europe faces. The outlook for growth has deteriorated owing to rising trade tensions, the ECB said in a statement. So while you have lowering interest rates to help consumption, you are also having a loosening in fiscal deficit norms by the biggies like Germany, and which could again offset this and improve the economy in Eurozone. So let's hope for that to be happening. So as we come to the end of the week, let's see what's been happening to the various markets. So the Nasdaq has fallen 2.6% since last Friday, and the S&P 500 has fallen lesser by 1.2%. Oil has gone up by 6%. Gold up by about 1.35%. Okay. So I think after the pause of 90 days by the US president, there's been some amount of optimism coming in, because of which some of these commodities which had fallen a lot jumped back, like oil. Even the equity markets initially reacted good, and later on they again started falling, because we really don't know what's going to be unfolding the next day. And each day brings about new measures, new news, and the markets are just reacting every day to the morning's news, which is, we are in a very low predictability zone as of now. So when the US president said that tariffs on electronics would be removed, markets were happy. But he has come back with some restrictive measures, and Nvidia suddenly discovers that they may have to write off or have a charge of $5.5 billion due to restrictions of chip exports to China. So China is the target right now, not the rest of the world. And with Nvidia stock pricing on the shock announcement, all other tech stocks also have been taking a beating, and the Nasdaq fell more than the other indices, 2.6%. Okay, gold has been having a yo-yo ride, one day good, one day bad. But on a whole, during the week, it was up 1.35%. So it fell again a little bit on Thursday on the hopes that with Japan having reported better negotiations with the US, things would calm down a bit and that's why gold came down. Remember, gold thrives on chaos. So if countries are able to negotiate better with the US and there would be better stability, a question worth asking is what will happen to gold prices from this peak? The Nifty has recovered a good amount since the last week and up almost 4%. And happily, the Nifty has recovered most or almost all of the losses since the announcement of tariffs. It's a reflection of the market understanding that India is in a better place than the rest of the world. And during the week, we've actually seen a surprise turnaround by FIIs, and they have been buying more in this week, which is a turnaround from selling all the last few weeks, which is great news for all of us. The dollar, the DXY, has dropped 1.1%, and the INR has dropped 0.5% in spite of all the FII inflows. So let's see what happens going forward. So having seen what's happening to the IT results in Q4, it'll be good to see what's happening to these indices. There are three indices we look at: the Nifty 50, the Nifty IT Index, and the Nifty Financial Services Index. All three speak a different story. The Nifty in the year to date is up 0.46%, whereas the IT Index is down 22%. And contrastingly, the Financial Services Index is up 10%. So there are three different stories. Investors are more confident of financial services because of valuation margin of safety and also a better growth potential coming up there. So these are helping banking stocks, and of course tech stocks are falling because of pessimism on growth. Good time to figure out what you have been doing with your portfolios. Okay, and some other good news is that SEBI bats for higher mutual fund exposure in REITs and InvITs. So they do believe that MFs would do well to invest more in REITs and InvITs, whereas the earlier limit was 10%. They're examining whether to raise that limit from 10% to whatever they will come out to, but they're talking about raising that, which is good. So that brings me to the end of Friday's newspaper. I'm wishing all of you a great weekend and a happy Easter.